Hello, everyone. Matt Somberg, partner and co-founder of Gottfried and Somberg Wealth Management. Hope you're well. Happy July. First half of the year is behind us, so let's take a minute or two to look back and see what happened and give you some perspective on what the second half of the year looks like. All right. First half really was excellent. That's the best way to sum up the performance of the major indexes for the first half of the year. The S&P 500 was up over 6, the NASDAQ close to 6, bonds were up 4%, and the breakout star the first half of the year were international stocks. Feels like for many years, occasionally clients will ask, why do we even own international stocks in our portfolio? They're always lagging US stocks. Well, here we go. It was an excellent year for international stocks so far, up about 18% for the first half of the year. Why? Primarily because the value of the dollar has declined. If you've traveled outside the United States this year, perhaps to a country where they have a different currency, you might have noticed that things were more expensive there than maybe the last time that you were there, or more expensive than you anticipated. As the dollar goes down in value, assets denominated in foreign currencies tends to go up in value, and that's a big part of why international stocks have moved higher this year. For the quarter, it was a historically good quarter. Historically, the S&P 500 going back to 1970 has averaged 2.5% in Q2. That's the historical average of what the S&P 500 has done. This year in the second quarter, the S&P was up nearly 11, the NASDAQ up 18, international stocks up 12, and bonds up 1.2. So an unusually strong second quarter. It was driven in part because of the weakness in the markets right before the end of the first quarter, followed by the drop off because of the Liberation Day worries about trade and tariffs in early April, and then just an incredible recovery and comeback afterwards. So as you see here with this chart, the tariff worries started here in late February. Liberation Day, the stance by the United States was much more firm than I think markets or investors wanted to hear. So a big drop between April 2nd and April 9th, a pause on April 9th, and then a steady comeback since with trade agreements being completed, Washington's stance becoming more soft, and just the markets have really rallied since off of their lows. The volatility was historic. What this chart does here is it describes to you something called the VIX, which is the VIX, VIX is sort of a way to measure fear. A normal day for VIX is in the teens in terms of its score. It's unusual for it to go through 30, and it's very unusual for the VIX to hit 50. We've highlighted the three times in the last 20 years when the VIX has hit 50: Great Recession, '08, peak COVID, 2020, and April 2025. That's how much fear was in the air in April. What we know is that when the VIX has eclipsed 50, or certainly eclipsed 30, that historically the forward-looking returns of the S&P 500, or the forward-looking returns of the market after that, historically have been quite good, as you can see here down below. So it was not a surprise to see, as the fears went away, the market rally. The S&P 500 almost hit bear market territory, meaning a 20% decline from peak to trough. From mid-February to early April, it was down about 19%. That's a very fast decline, 48 days, but it's taken only 80 days for the market to not only go back up, but get back to an all-time high, which happened on June 27th. So this is the fastest recovery in the market's history. So if you fell asleep in April, you missed a lot, but you woke up at the end of the quarter to see the market recovering nicely, and just an excellent result for the S&P 500. What was behind this? What was driving it? So each sector, there's 11 sectors. Each sector would have been impacted differently by some of the initial trade and tariff stances out of Washington. The three that were probably the most worried were the technology sector, communication sector, and the industrial sector. And those not only went down significantly, but they also recovered quite quickly. So from the lows of April, the tech sector is up 42%, communication up 30, and industrials up 27. So a little bit of buying during the April lows, really in any sector, but primarily those three would have delivered some nice forward-looking returns off of the bottom in early April. So it's nice to see the market recover. And it's also nice to hear from companies in terms of what their earnings expectations are and how they're doing. S&P 500 earnings expectations have come down a little bit. There's certainly a little bit of uncertainty in terms of how our economy is doing or the impact from trade and tariffs. But consensus earning expectations for the 500 companies in the S&P is still year over year 9% from 2024 to 2025. And the forward-looking expectations from 2025 to 2026 consensus is still 14%. So companies still feel that their earnings can grow and they will accelerate into 2026. Why? The overall economy is pretty stable. Inflation has certainly come down. Inflation is still between 2 and 3%, which is reasonable overall. The unemployment rate is quite stable. We're in the low fours. Obviously, there's a little bit of worry in terms of how things like artificial intelligence might be impacting companies. Do they still need to hire as many people as they once did? Do we no longer have as much demand for labor from employers as we had in the past? Um, but the overall unemployment rate is quite good as well. Federal Reserve, we've talked quite a bit about interest rates in the past. The Fed is sort of taking their time to see if they need to, in all likelihood, lower interest rates. With inflation stable and unemployment stable, there's not a pressing need to do much. Obviously, those who borrow money would prefer to see rates lower. Companies would prefer to see rates lower so that they can borrow at lower rates. Certainly, the president has been outspoken about wanting to see interest rates lower, but the Fed has taken a little bit of a wait and see perspective. I wouldn't be surprised if we're filming one of these videos in the fall, if we're on the cusp of seeing the Fed maybe start to cut interest rates. Would not be a surprise to see rates lower by the end of the year. But at the moment, the economic data is reasonably good, and the Fed doesn't really feel any pressure to lower or to raise, which is certainly less likely to happen. So look, here we are. It's early July. The indexes have had a great first half of the year. It was pretty volatile, a little unnerving in April with some of the trade and tariff worries, but in hindsight, it was an opportunity to do a little bit of buying if people had cash or the opportunity to rebalance. So we'll be back in touch probably at the end of the summer to check in with you and provide a little bit of an update for you then. Of course, if you need anything, don't hesitate to reach out to our office, to the advisor that you communicate with the most. Always appreciate your trust and your confidence, and hope you have a great summer. And we'll see you in a few weeks. Thanks very much.